For the third year in a row, Western Asset Management's main fund is beating similar strategies of its rivals like BlackRock and PIMCO after falling behind in 2007 and again in 2008. My colleague Julie Hyman is standing by with the company's chief investment officer. Julie?
Indeed, and that is Stephen Walsh. He's chief investment officer at Western Asset Management. The company has about $433 billion under management. And you mentioned some of the numbers for it, Mark. The flagship Western Asset Core Plus bond portfolio, it's been in the 84th percentile for the past year, and it's returned more than 5%, in fact, more than 5.5% for the past 12 months. So, Steve, thank you so much for coming in. It's good to see you here in the studio. You know, I think we have to start with Europe. That's where everything seems to start these days, whether you're talking about equity investing or fixed income investing. How is that informing what you guys do right now?
Well, obviously, it's a really huge issue. It's all Europe all the time as investors try to grapple with understanding whether policymakers will be able to cobble together a program to resolve their sovereign crisis. So it's right out in front of virtually everything we do. There's not a decision you can really make, whether you're thinking about interest rates or should I take more risk in the corporate bond market, that can't contemplate what your view on Europe is.
And so what is your view on Europe?
Yeah, we've been pretty open with saying we don't know how you can know. It's almost as if I don't know. Or how can I have a lot of conviction in an expected outcome? And while we're always faced with taking uncertainty into account when making investment decisions, seldom is the downside risk as substantial as it is if Europe were to fail. That sort of cliff risk has kept us much more cautious in taking risk within the credit markets like high yield and the other sort of investment grade credit markets that we confront each day.
What about the markets that are most directly exposed, meaning the sovereign debt of nations like Italy and now Spain and even countries like France?
Sure. We don't have, in our U.S.-based portfolios like the Core Plus fund you referred to, we do not have exposure to any of the periphery at all. And our exposure in Europe is primary Germany. Now, the second level of exposure would be banking institutions in those countries. And we do have some Bank Santander debt, for example, out of Spain. We own some UK debt and RBS and Lloyd's names, for example. And we own a little bit of French bank exposure as well. But the primary direct exposure to the European periphery were not existent at all.
Do you think that what has happened in Europe has sort of changed the game in terms of sovereign debt investing? I mean, it used to be that even for countries like Greece, Italy, people piled into the sovereign debt and they considered it to be a relatively safe investment.
Right.
Do you think that's just, that's off the table now, not just in the near term, but sort of is a game changer?
Well, I think it is moving off the table. I mean, our entire global financial system is based on the premise that sovereign debt is risk-free. Regulators let banking institutions hold sovereign debt with zero risk capital, sending them the message this stuff is fine. I think what we're seeing in Europe is certainly in the periphery, maybe to a certain extent Italy and Spain, these markets are going from risk-free to a more credit market. It's credit paper, like investment-grade credit bonds. And suddenly the universe of buyers for that asset class is a lot smaller than it is for risk-free periphery or Europe or sovereign debt. So yes, I do think we're going through a transition where this sort of what we all grew up on, that sovereign debt is risk-free, is losing its reality, and we're seeing it in Europe today for sure.
So is the default just has to be treasuries then? Is that going to keep the yields where we have seen them or even lower?
Well, it's certainly to keep a risk premium within treasuries. It's that kind of flight to quality. I think it's German bunds. It certainly to date has been the UK gilt market as well. Some questions about how long that can stay up within the UK market. But I do think, yes, treasuries and maybe German bunds are going to be the risk-free asset during this period of great deal of anxiety over Europe.
Now, you guys have, of the Core Plus bond portfolio, you have about 16% in treasuries, but you guys still have a good amount in investment grade credit, about 19.5% as of the end of September. I was talking about a story earlier on Mark's show about how the corporate bond market volumes have really dropped off a cliff, down 37% since January. So what does that mean for your purposes? You don't have a lot of choice in the corporate bond market in terms of issuance or in terms of volume. How are you negotiating that?
Yeah, I think it's one of the untold stories today. The liquidity in the bond market has evaporated, and some people argue, well, that's just because of all the uncertainty over Europe, or gosh, we're going into year end. But I think it has the potential to be something more pervasive and something more long-term in terms of the impact of Basel III or Dodd-Frank or the Volcker rules that just came out last month. We have found that in moving only the highest quality paper can you get much size done. Our London-based desk this morning tried to buy 100 million French bonds. The bid-offered spread on a 10-year note of French bonds was a full point. So even French government bonds, AAA, we found very, very low liquidity. And I worry that's going to be with us for a time. And that certainly would be a concern, not just for the sell side, but for buy side firms that need to move their portfolios around from one asset class to another.
And do me a favor, if you would, and sort of connect the dots between Dodd-Frank and Volcker, et cetera, and then the lack of liquidity that we're seeing.
Well, I think it's creating this environment. Well, there's obviously a lot of negative press towards banks, right? Banks are bad, Occupy Wall Street, they've done bad things. And I think the result of that and the litigation risk that they're under, as well as the looming regulations that are coming to that industry, are all designed to reduce risk taking on their part. Maybe that's a good goal. Maybe they need to be less casino-like and more utility-like. But the path to get there and the unintended consequences that could come from this increased regulation and some of the rules that are contemplated by Dodd-Frank, I think or by the Volcker rules, I think could change the secondary market in fixed income forever, and not in a good way. And the implication would be much higher borrowing costs for virtually anyone that uses capital markets, whether you're a small tool and die company out of Cleveland or you're a credit card, you own a credit card receivable.
And what does that mean for you in your investing decisions as well?
Well, if we have less liquidity in the market, first we need to go lobby. I think we do need to lobby some of the rules that are contemplated by the Volcker rules. I think there's some things that would really be a game changer for the way the over-the-counter fixed income market works. Secondarily, if liquidity is less than it was in the past, I think we need to build that into the cost of capital. So if we previously liked a corporate bond at 200 over, maybe today we need to ask for 250 basis points over on spread. We need to get paid more to own a security that is a lot less liquid than it was during the 90s and 2000s. So demanding more, wider spreads, i.e. higher borrowing costs to the ultimate issuer of that debt, is something that the buy side will need to go through over the course of the next few years.
Steve, it was great to talk to you. Thanks again for coming in while you were here in New York.